Enterprise value tells you the real cost of buying the entire business. It reveals the true worth of the company, the weight of its debts, the strength of its cash, and the cost of being the actual owner. The formula of calculating enterprise value looks simple. It's market capitalization plus total debt minus cash. Cash is subtracted since it reduces the net cost of acquisition. Rather than looking only at the market capitalization of a company, we should focus more on the enterprise value of the company for valuation. Now ask yourself, when you look at your portfolio, do you know the enterprise value of the companies you hold? Or are you trapped in the surface numbers like most traders? Now let's understand enterprise value with the help of a simple example. If you buy a small shop for 50 lakh rupees, but it also has cash of 10 lakhs in its bank accounts, carries a loan of 30 lakh rupees, you effectively paid 70 lakh rupees for the shop. That is what enterprise value is all about. Enterprise value is compared with various financial metrics for the purpose of valuing a company. Valuation multiples built on enterprise value are considered to be the most reliable. 3 of the most widely used EV multiples are EV/EBITDA, enterprise value to earnings before interest, taxes, depreciation, and amortization. It asks a simple question: how much are you paying for every unit of operating profit before non-cash charges that this company generates? EBITDA focuses on core operations, making it easier to compare companies across different tax regimes, capital structure, and accounting policies. Next valuation ratio is EV to sales or enterprise value to sales. It tells you how much are you paying for each rupee of sales generated by the company. It is one of the simplest EV multiples. By focusing only on top-line revenue, it bypasses accounting complexities around costs and profits. EV to sales is used by startups and high-growth companies that may have negative earnings but are growing very fast. EV to EBIT focuses on enterprise value relative to operating profit after depreciation. Unlike EBITDA, EBIT includes depreciation and amortization, which represent wear and tear of assets and consumption of intangibles. Companies with high depreciation in capital-intensive industries like airlines, telecom, capital goods may show inflated EBITDA. In such cases, EBIT provides a grounded view. Enterprise value is one of the most powerful tools in valuation, but powerful tools can be dangerous in the wrong hands. So today, we're going deep into the biggest mistakes people make with enterprise value, so that you can invest smarter and think like the pros. Mistake number 1 is ignoring the role of debt. Many people look at EV, but don't dig into what kind of debt it is. Short-term debt, long-term debt, convertible debt, they all have different risks. A capital-intensive company like an airline will naturally have higher debt than a software company. That doesn't make it bad, but you must factor it into whether earnings can cover the interest. Mistake number 2 is subtracting all cash without checking. Cash lowers EV, but some cash isn't really spendable. It might be restricted cash, locked in overseas deposits, or tied to legal requirements. Subtracting it blindly can make a company seem cheaper than it actually is. Mistake number 4 is comparing EV across different industries. EV ratios like EV/EBITDA are useful within the same industry, but meaningless across different ones. Capital-intensive industries naturally have higher EVs. Compare like with like, or your analysis will be flawed. Mistake number 7 is ignoring growth potential. EV is about the cost today, but growth determines tomorrow's value. 2 companies can have the same EV now, but if one is growing at 20% and the other is stagnant, the better long-term bet is the high-growth company. Mistake number 8 is not adjusting for one-time events. EV-based ratios can be skewed by temporary events like property sales or legal settlements. Without adjusting, you could misread the company's real performance. Mistake number 10 is using EV in isolation. EV is powerful, but it's just one piece of the puzzle. Combine it with metrics like P/E ratio, ROE, and debt to equity for a complete picture.